Here's a question that should keep you up at night. China dumped $630 billion in U.S. Treasuries. India sold $50 billion more. That's $680 billion in less than 2 years. So why didn't the bond market collapse? Think about it. When the two biggest buyers in history walk away, prices should crater. Yields should explode. Mortgage rates should detonate the economy. But that didn't happen. On the surface, everything looked fine. Yields rose a bit. No panic, no crisis. Which led most analysts to the wrong conclusion. See, China's exit doesn't matter. The system adapted. But here's what they missed. Systems don't adapt. They substitute. And when you dig into who absorbed $680 billion in selling, you'll see something terrifying. Because the answer isn't new demand. It's borrowed capacity. And capacity, unlike demand, is finite. In the next 15 minutes, I'm going to show you exactly who's holding this house of cards together, and why they can't do it much longer. If this is your first time here, subscribe, because what's coming next will change how you see every financial headline. If this is your first time here, subscribe, because what's coming next will change how you see every financial headline. Let me show you how they pulled this off. When China started selling in 2022, basic economics says, more supply plus less demand, lower prices. In bonds, lower prices, higher yields. And higher yields should have been catastrophic. Mortgage rates above 10%, regional banks facing mark-to-market losses, $36 trillion debt becoming mathematically unpayable. None of that happened. Why? Because the selling didn't disappear. It was absorbed. And when you look at the Treasury international capital data, the reports that track every major foreign holder, you see something bizarre. As China's holdings fell month after month, two names surged: the United Kingdom, Belgium. On paper, it looked reassuring. Look, new buyers emerged. In reality, it was a warning. Drop a comment if you can guess why Belgium, a country smaller than Maryland, is suddenly holding $370 billion in U.S. debt. I'll tell you the answer in a minute, but I want to see your theories first. By late 2025, the UK holds $750 billion in U.S. Treasuries. Let that sink in. Britain's economy is 1/6 the size of China's. The UK runs a deficit. They don't earn surplus dollars from trade. So where are they getting $750 billion? They're borrowing it. They're levering it. British banks, pension funds, insurance companies, they're absorbing what China's dumping by expanding their balance sheets. The UK financial system became a shock absorber for the US Treasury market. Here's the problem. We've seen this movie before. September 2022. Remember? British pension funds were using something called liability-driven investment strategies. Basically, borrow against bonds to juice returns. Worked great, until UK bond yields spiked. Bond prices collapsed. Margin calls hit. Pension funds had to sell the collapsing bonds to meet the calls, which pushed prices lower, which triggered more margin calls. A doom loop. Within days, the entire UK pension system was on the verge of systemic collapse. The Bank of England had to do emergency bond purchases just to stop the cascade. That crisis wasn't caused by war, not by external shock, just balance sheet stress. And now, less than 3 years later, Britain is holding $750 billion in foreign debt on top of its own obligations, while running a deficit, while facing slow growth. This isn't strength, this is strain. If you know someone who thinks the bond market is fine, share this with them. They need to see what's actually holding this together. Now let's talk about Belgium. $370 billion in U.S. Treasuries. Belgium's entire GDP is only $600 billion. They don't have a massive sovereign wealth fund. They don't run huge trade surpluses. So how is this possible? Simple. Belgium isn't the buyer. Belgium is home to Euroclear, one of the world's largest securities warehouses. It's not a buyer. It's a custodian. When you see Belgium in the data, you're not seeing Belgian investors. You're seeing central banks that don't want their purchases visible. Sovereign wealth funds operating through intermediaries, institutions using Belgium as a legal address. Belgium is camouflage for whoever's actually buying. And here's what makes this dangerous. The surge in UK and Belgian holdings didn't happen randomly. It happened in exact synchronization with China's exit. October 2025. China sells $12 billion. UK and Belgium absorb nearly the same amount, month after month. The pattern is precise. This wasn't the free market finding new demand. This was coordination. Comment below. Do you think this coordination is sustainable? Or are we watching a controlled demolition in slow motion? Why not just let the market clear naturally? Because natural price discovery would break the system. If yields rose to where they should be without this coordination, regional banks would collapse from bond losses, mortgage rates would hit 8 to 9% plus, government interest expense would spiral into fiscal death, emergency monetization would be forced immediately. None of that is politically acceptable. Not before elections, not before transitions, not before managing the narrative. So they chose stabilization over truth. China exits, allies absorb. India exits, custodians absorb. Private demand fades, political demand replaces it. Economic buyers, who bought for profit, have been replaced by political buyers, who buy for survival. And here's the thing about political buyers. They're not reliable. They buy until one of three things happens. Their currency cracks, and they must defend it. Their voters revolt against supporting foreign debt over domestic needs. Their own bond markets break under dual obligations. At that moment, they stop being buyers. They become sellers. This is the nightmare scenario. Forced buying always creates forced selling. If the British pound weakens, the Bank of England must defend it. To get pounds, they sell foreign assets, including treasuries. If Japan's yen collapses past 160, 170, they must sell treasuries to get dollars to buy yen. If Europe faces a sovereign debt crisis, say Italy's yields spike, Belgium's custodial balances start unwinding. And if multiple substitutes reverse simultaneously? The illusion of demand disappears, not one shock. That's when price discovery returns. And price discovery after years of suppression is never gentle. Question for you. Which breaks first, the UK, Japan, or Belgium? Drop your prediction in the comments. I'll pin the best analysis. When the substitutes fail, only one buyer remains, the Federal Reserve. Not because it wants to buy, because it has no choice. When private buyers exit, when foreign buyers exit, when political buyers become forced sellers, the central bank must step in, not to rescue markets, to replace them. We've seen this before. 2008, Fed bought mortgage-backed securities when no one else would. 2020, Fed bought corporate bonds, ETFs, treasuries, anything to prevent liquidation. And when the Fed becomes the buyer of last resort for U.S. government debt, it's not temporary emergency policy. It's the endgame. Because once the central bank starts monetizing government debt at scale, it can't stop. The debt must be rolled over. The government can't cut spending fast enough. Private buyers won't return at sustainable yields. So the Fed prints. And keeps printing. It's always framed as temporary. Emergency measures. Until markets stabilize. It never is. Let me trace the sequence so you see the full picture. Stage 1. China selling created pressure. Stage 2. India exiting removed legitimacy. Stage 3. Hidden buyers delayed consequences. Stage 4. We are here. But delay is not resolution. It concentrates risk. The Treasury market is no longer supported by trade flows, countries earning dollars and recycling them naturally. It's supported by coordination, allies absorbing, custodians hiding, central banks preparing to intervene. And coordination is fragile, because it requires all participants to keep cooperating. The UK keeps levering despite balance sheet strain. Japan prioritizes Treasury holdings over yen stability. Belgium's clients keep parking assets instead of liquidating. If any link breaks, the chain breaks. When the chain breaks, Fed becomes the buyer. When the Fed becomes the buyer, dollar becomes the mechanism. When the dollar becomes the mechanism, monetization begins. Print dollars to buy treasuries. Issue treasuries to fund deficits. Print more dollars to buy more treasuries. That's not a market. That's a death spiral. And the end is always the same. Currency debasement. Not overnight, not with hyperinflation headlines, but through steady, irreversible loss of purchasing power. How are you protecting yourself against this? Comment your strategy. I read every single one, and the community here has incredible insights. This isn't about panic, it's about capacity. Here are the exact signals I'm tracking. 1. UK gilt volatility. If British bond yields spike suddenly, balance sheet stress is back. Yen intervention frequency. If Japan intervenes multiple times per quarter, they're burning through treasuries. 3. Belgium's custodial balances. If holdings flatten or decline for consecutive months, absorption capacity exhausted. Fed's balance sheet. If it expands without a stated crisis, the hidden crisis arrived. These don't appear in headlines. They appear in data. When absorption slows, when custodial growth stalls, when political buyers hesitate, price discovery returns. I track all of this in real time for subscribers. Hit that button if you want the early warning system, because by the time CNBC reports this, it's already over. The system didn't find new demand. It found new balance sheets. That bought time, not stability. China left, $630 billion gone. India stepped away, $50 billion liquidated, 274 tons of gold moved home. Now the substitutes are stretched, the UK levering to absorb, Belgium warehousing to obscure, Japan caught between yen defense and treasury absorption. This is what late-stage systems look like. Not chaos, compression, not collapse, strain. The failure doesn't start when markets fall. It starts when no one wants to be the next buyer. But here's what we haven't examined yet. What happens to the dollar itself when the Fed becomes the primary buyer? What happens when monetization, printing currency to buy bonds, becomes permanent policy? And what does stage 4 completion look like when the reserve currency transitions from market-based to central bank sustained? These aren't hypothetical questions. They're the next stage. Because the hidden buyers are running out of capacity. The UK can't stretch indefinitely. Belgium's warehouses have limits. Japan faces its own currency crisis. When capacity exhausts, the Fed steps in, not as lender of last resort, as buyer of last resort. That's the transition to stage 4 completion. From market-based demand to central bank monetization. And once monetization begins at scale, the next question becomes unavoidable. What happens to a reserve currency that's being printed to fund its own government? That's the final fracture. The currency itself. The British didn't understand in the 1880s that their capital was building America while their empire hollowed out. Americans don't understand now that the treasury market is no longer a market. It's a coordination mechanism approaching failure. But the pattern doesn't require your understanding. It executes whether you see it or not. If you want to track the absorption capacity as it exhausts, if you want to see Fed intervention before it's announced, if you want to recognize when markets become monetization, subscribe. Share this with someone who needs to see it, and comment your biggest takeaway. Because systems don't fail in headlines. They fail in plumbing. And we track the plumbing. Flows don't lie. Welcome to Geopolitics of Money.